Alright, so chapter 2, let's take a look at some basic accounting concepts. So we're going to look at the basic elements of a system, and then we're going to look at some transactions from the corporation's first period of operations. We're going to analyze and record them in the second period of operations, and then we're going to take a look at some financial statements. So let's look at the basic elements of a system. So basic rules. So the basic rules of an accounting system, they're going to determine what transactions, when they're recorded, how they're recorded, and how much is going to be recorded. So you ask yourself, what's a transaction? Transaction is an economic event that could affect one, two, or more items in the financial statements. So let's think about something. So if a company buys a truck with cash, that affects assets because cash goes down and truck equipment goes up. If a company purchases a piece of land with cash, so cash would go down, which is an asset, and land would go up, which is an asset. So let's take a look at another transaction. So a company sells common stock for cash. Cash would go up, which is an asset, and stock would go up, which is part of stockholders' equity. So that's what they mean by it can affect one or two more items in the financial statements. Our example where we bought land, it only affected assets. Our example where we sold stock affected assets and cash, and stockholders' equity and common stock. So let's look at the framework for an accounting system. So the accounting equation, remember this from chapter 1, assets equals liabilities plus stockholders' equity. If you don't remember what assets, liabilities, and stockholders' equity are, this would be a good time to go back to chapter 1 and review the definitions and some examples of each. So the integrated financial statement, this is what we looked at in chapter 1. So we can take a look at the integrated financial statements. So if we look at our statement of cash flows, our ending cash balance on the statement of cash flow should equal our cash balance under assets on the balance sheet. Our net income or loss goes into our ending retained earnings calculation on our retained earnings statement, and that goes up to stockholders' equity on the balance sheet. So the three financial statements are interconnected. So if we look at some controls of an accounting system, so always, the accounting equation must balance. Assets equals liabilities plus equity. As we move forward in this course and you analyze a transaction and your analysis takes the accounting equation out of whack, that means something is wrong, and that's a trigger to go back and look at it. The accounting equation always has to balance in accounting. Ending cash on the balance sheet always equals ending cash on the statement of cash flows. If these do not equal for some reason, something is wrong. Finally, net income on the income statement goes into the retained earnings statement. That's that interconnection we looked at on the previous slide. It always has to happen. Alright, so let's take a look at some transactions for a corporation's first period of operations. Again, if you need to go back and review what a corporation is, this would be a good time to go back to chapter 1 and review. So we're going to look at Family Healthcare Professional Corporation. That's what PC stands for. So our first transaction, Dr. Landry is going to invest $6,000 to start his practice. So if we look at the impact, assets, cash increases by $6,000. Because remember, we're looking at Family Healthcare Professional Corporation, not Dr. Landry's financials. So Family Healthcare Personal Corporation, their cash went up $6,000. And then on the other side of the equation, capital stock went up $6,000 because Dr. Landry got $6,000 worth of stock ownership in exchange for the cash. And then if we look underneath at our statement of cash flows, in financing activities, we had a $6,000 cash inflow. So we tie out. Our statement of cash flow shows a $6,000 inflow. Our asset cash account shows $6,000. And our stockholders' equity shows $6,000 in capital stock. So assets equals liabilities plus stockholders' equity, $6,000. We're good. So now we're going to borrow some money. So we're going to borrow $10,000 from First National Bank. So let's look at the transaction. So our cash increased $10,000. Why? Because we're borrowing money from the bank and putting it in the bank as cash. So our cash increases $10,000. And then on our statement of cash flows, this impacts our financing activities because we're borrowing money and it's a $10,000 cash inflow. So our financing activities, $10,000. But for that $10,000 from the bank, we incurred what's called a note payable with the bank, which means we have to pay it back. It's a liability. So there's our $10,000 note payable in the liabilities section of our balance sheet. So let's take a look at our balances. $16,000 cash, assets, equals liabilities plus stockholders' equity, which is $10,000 plus $6,000. So $16,000 cash equals $16,000 liabilities plus stockholders' equity. The accounting equation balances. So again, the loan from bank increased our cash assets and increased our notes payable liability. So now we're going to buy some land. So we bought some land for $12,000 cash. So what happened? If we look at our purchase of land, our cash went down $12,000 because cash went out the door to buy something. Cash went down. And we acquired land. So the land account under assets went up by $12,000. And if we look at our statement of cash flows impact, it's an investing activity because we purchased an asset. So that shows negative $12,000 because it's a $12,000 cash outflow. If we finally look at our balances, if we add up the cash and land, we show $16,000 of assets. If we add up the liabilities and stockholders' equity, we show $16,000. So our accounting equation balances. Again, we decreased cash asset $12,000. We increased land asset $12,000. So our accounting equation is still intact. Earning of fees. So family health care, we earned fees of $5,500 and we received it in cash. So we did some work for $5,500 and we got paid in cash. So if we look under D, fees earned, our cash increased $5,500 because cash came in the door, and our retained earnings increased $5,500. And if we look underneath our statement of cash flows, we had an incoming operating cash flow of $5,500 because cash came in the door based on operations. And see our income statement, we had fees earned of $5,500. So we had revenue of $5,500, which if we remember how our income statements work, our income statement flows into our retained earnings section, a retained earnings statement, and then our retained earnings goes up to stockholders' equity. So here we show increase in cash on our balance sheet of $5,500, increase in retained earnings on our balance sheet of $5,500. And then we have a $5,500 revenue on our income statement and a $5,500 operating cash flow on our statement of cash flows. So now we're going to pay some expenses. So we incurred $2,900 of expense for various things, and we're going to pay $2,900 in cash. So we had $2,900. It could be the electric bill, something like that, but we're paying cash for it. So what do we show? Under E, paid expenses, our cash goes down $2,900 because our cash went out the door. We show a $2,900 negative to our retained earnings because that goes to our income statement. So if we take our income statement, our expenses go into the retained earnings statement and then retained earnings into the balance sheet. So an easy way to remember this is that revenue increases retained earnings and expenses decrease retained earnings. So in this case, $2,900 of expenses decreased retained earnings and decreased cash because cash went out the door. And not to be too confusing, but if you look at the income statement underneath in pink, it broke the $2,900 out into 5 different categories of expense. So you incurred all 5 of those expenses totaling $2,900. The key here is revenue increases retained earnings on your balance sheet, expenses decrease retained earnings on your balance sheet. Again, we decreased cash $2,900 because cash went out the door. We decreased retained earnings $2,900 because it's expenses. Now we're going to pay some dividends to our stockholder. So we're going to pay dividends of $1,500 to our stockholder, Lee Landry. So if we look under paid dividends, we cut a check and cash went out the door for $1,500, so cash goes down. Under stockholders' equity, we went down $1,500. So again, our rule, revenue increases retained earnings, expenses decrease retained earnings, and dividends decrease retained earnings. And under our statement of cash flows, that's a $1,500 negative cash outflow to financing activities because we paid dividends to our stockholder. And note, this does not, paying a dividend has no impact on the income statement because it's not a revenue or an expense. It's a cash dividend. Again, $1,500 went out the door, so cash went down $1,500. And retained earnings went down $1,500 because we know that that's the impact that dividends have. So let's take a look at the financial statements now. So of all these transactions, our ending balance in cash on our balance sheet comes out to $5,100. By all, we take all 6 of our transactions we looked at. And then underneath in green, if we look at our ending balance from our statement of cash flows, we also get $5,100. So we tie out. We're good. Our land account has $12,000 in it because we purchased some land. So our total assets equal $17,100. If we look at our other side, we had our note payable as a liability from our bank loan. We have in our stockholders equity section, we have capital stock from our investment from the doctor up at the top. And then to increase retained earnings, we have our income. To decrease retained earnings, we have our expenses. And to also decrease our retained earnings, we have our dividends. So if we add up our liabilities and stockholders' equity, we take $10,000 plus $6,000 plus $1,100, we also come to $17,100. So assets equal liabilities plus owner's equity. Another thing to look at is if you look at D&E, $5,500 of revenue and $2,900 of expenses, if you net those out, revenue minus expenses, you get $2,600. If you go underneath to the income statement, you'll find that net income equals $2,600. So from all of our rules, the statement of cash flows, cash equals our ending cash on the balance sheet. Our income statement, net income, flowed into retained earnings, and our assets equals liabilities plus stockholders' equity. Our financial statements are good. Yep, and here's illustrating the rules. The cash balance is equal. Our net income, down at $2,600, ties out to our revenue minus expenses that we put into retained earnings. So let's take a look at some observations. So what we ended up doing is when we issue capital stock, that increased our stockholders' equity. We paid dividends, that decreased stockholders' equity. Revenue increases stockholders' equity, and expenses decrease stockholders' equity. This is a very good slide to study and get to know. So let's take a look at some financial statements. So here's the transactions that happened. This is the summary of transactions that we just looked at and that we just put together. So here's our income statement, our balance sheet, in our statement of cash flows. So let's look at our income statement. So from the chart that we looked at on the previous slide, we know that our revenue is $5,500. We know that we had $2,900 of expenses in those 5 different categories, and our net income is $2,600. So this is our example of our income statement. So our retained earnings statement, so we take our net income, which increased retained earnings, our dividends, which decreased retained earnings, and we get our ending retained earnings balance of $1,100, which ties out to the integrated financial statement view that we looked at a couple slides ago. Our balance sheet, we add up our assets, our cash and land, we get $17,100. Then we have $10,000 of liabilities, the note payable, and then we have $7,100, our stockholders' equity, which is our retained earnings plus our capital stock. And if we add up the liabilities and equity, we get $17,100. So assets equals liabilities plus stockholders' equity. Our statement of cash flows. So we take our same analysis from the integrated view we looked at a few slides ago. So our cash flow from operating activities is $2,600. We received $5,500 cash from customers, and then we paid some expenses of $2,900. So that's where we get our $2,600. If we look at our investing activities, we bought land. So that's our negative $12,000 cash outflow. And then from financing activities, we sold stock. We received cash from the bank from our note payable, which were cash inflows. And then we had the one cash outflow, which was our dividend we paid to our stockholder. So our cash flow from our financing activities was $14,500. So if we add up the $2,600 less $12,000 plus $14,500, our net increase in cash was $5,100. Since this is a new company, our beginning balance was $0, so our current cash balance is $5,100, which should equal the cash balance that we had on our balance sheet. So here's our integrated financial statements. So we see our statement of cash flows, our ending cash balance came out to $5,100. The $5,100 in the cash flows equals the $5,100 cash on the balance sheet. And then if we look at our income statement, we get our $2,600 of net income, which was added to retained earnings in the retained earnings statement, and then we subtracted our dividends to get $1,100 balance in retained earnings, which we moved up to the balance sheet in the retained earnings section of the stockholders' equity. All right, let's take a look at the second period of operations. So here's everything that would have happened in the company in October. So you can take a look at this example on your own. And finally, we're going to prepare financial statements for the second period of operations. So here's our summary of the transactions in the financial statement view. So again, we're going to take the balance sheet items, the statement of cash flow items, our changes to retained earnings, and our income statement items, and we're going to prepare the financial statements. So here's our income statement. Revenue minus expenses equals our $3,220 net income. Retained earnings. We had a beginning balance of $1,100, which we calculated before for the first month of operations. We add net income, we subtract dividends, and we get our ending retained earnings balance of $3,320. Our balance sheet, we take our assets, which are cash and land, we get the $19,320. And under liabilities, we have our note payable of $10,000. And then under stockholders' equity, we have our capital stock, and our ending retained earnings balance that we brought over. We add the stockholders' equity to the note payable, we get $19,320. Assets equals liabilities plus equity, our balance sheet balances. Our statement of cash flows. So we take our operating activities, investing, and financing activities from the transaction view a few slides ago. We get our net increase of cash of $2,220. We add that to the beginning balance of $5,100. The $5,100 comes from the ending cash balance from the September example we did before. So if we add our beginning balance plus the 2,220 net increase, our ending cash balance is 7,320, which also equals the cash balance that we have on the balance sheet. So if we look at the integrated financial statements, again, we can follow. Our ending cash balance of 7,320 equals our cash balance on the balance sheet. Our net income went into our retained earnings calculation of 3,220. We move up retained earnings into the balance sheet under stockholders' equity, and then we find that assets equals liabilities plus equity. So our financial statements all tie up. And that's the end of Chapter 2. So there will be a solution for you to review and homework, and please let me know if you have any questions.